Hey, welcome back. PayPal has been a very interesting stock in the past half a decade. Despite the company improving, the stock fell by 80% from the peak they had during the pandemic hype, and now they are still 40-50% below the pre-pandemic level. They can make 4-5 billion in free cash flow, which is not bad for a 60 billion market cap, and that's about the lowest ratio in a decade or even ever. We can see a very nice cash flow in Q1, and overall in time they seem to be very resilient. I'll come back to this later when we see where this money goes, but now I want to focus on the main arguments I see for and against this investment. I don't have a position, so I guess my opinion can be somewhat unbiased. Now, there is the argument of huge competition and no competitive advantage. Yes, there is a lot of competition and having a moat is very difficult. I think it's ultimately about marketing, meaning product, price, placement or convenience in this case. They have a variety of clients, but in general, if you manage to meet the needs without them having to adapt to your offering and do it at a good price, you should be okay. But as you are about to see, they are surprisingly more than okay. On the other side of the argument, this has been the case for many years and yet they kept and keep developing. For example, apparently they have a 41% market share in online payment processing. And that's with Adyen, Square, Stripe and so on. It doesn't mean that they will keep doing it and we can never know what happens in the long term, but given all the competition, they were very resilient. Maybe it's a case where everyone in the market grew together with the market and they just didn't grow as much as they should. Comparing them to the competition, however, we have Adyen, a close to $40 billion company, making around $2 billion, so 30% cheaper but making less than half of the money. The revenue has been very volatile, and keep in mind that this is a European company, which are generally a bit cheaper than American ones. Square or Block, on the other hand, are also a $40 billion company that doesn't really make money right now, yet they pay almost the same amount of compensation as PayPal. They have a lot of revenue and it's growing kind of in line with PayPal's, but they still have to turn it into money. It's easy to make revenue when you're selling, let's say, $1 for 50 cents, but when they finally want to make money, meaning adding some fees or higher percentages, people may not be interested. So, relatively speaking, they actually grew pretty well. Another issue that people have is the huge stock-based compensation. Sure, maybe it's a bit higher now since a lot of the management team was replaced and they probably had to give some to both the ones that left and the new ones, which is a one-time thing, but they were high even before. Let's say 1.4 billion on a 5 billion cash flow, that's 28%. But it's a double-edged sword. And look, I know and I even met some people who work in this kind of position, and I'm talking about some top management people in big companies in Europe. I'm not saying they are all the same, but looking at their actions, they care about getting as much growth as possible as soon as possible, no matter how sustainable it is, and then they leave the company in 3-4 years when the shares they get are no longer restricted. Then they move to the next company with the money and the enhanced resume, and whoever takes the position tries to save them or does the same. But I think there are at least two types of people, and if you are lucky and find a truly smart person that cares about making even more money in the long term, they can really do their best and make a difference. And as a parenthesis, companies like Meta or Alphabet also pay a lot, sometimes even more than PayPal as a percentage of the cash flow. And you can argue that they aren't in the shape to do it with all the issues, but look at what other companies do. You know, when Meta had issues and crashed like 80% in 2022, they didn't stop. In fact, they paid like 60% in SBC that year, which was 2 times more than in 2020. And to be fair, maintaining a very solid cash flow and growing the revenue in such a market isn't so bad. So yes, it's a lot of money, but this is overall kind of a normal amount of compensation for this kind of company, and I don't see it as a compelling argument. If it was a simple cash payment, they wouldn't generate any demand in the market and the stock would probably crash even more, so it's also kind of a favor for the shareholders. There is also the customer dissatisfaction, bad engineers, bugs, probably old or outdated code and so on. I don't know if it's just the usual loud minority of unsatisfied clients, because if it was that terrible, then why do they keep increasing the number of users and the transactions? If it's that bad, wouldn't they switch to another app? I'm looking at the argument and all the negative reviews, but the numbers don't add up. How can they still have 40-something% market share if the product was that terrible and they have so much competition? The number of active accounts and merchants grew at a compound annual growth rate of almost 10% during the past half a decade. And another point that's somewhat related, they have high fees. I guess it's true, but the thing is, the competition probably goes bankrupt if they keep it up or has very low or unsustainable margins, while PayPal has more than enough room to cut them. Again, you can sell a lot of dollars for 50 cents, but you can't do it forever. It's a matter of management, but it's something that if it becomes an issue, can be fixed really fast. And if they lower the fees, they might be able to win from the volume, but right now I don't think they have to. Financially, they are in good health with the current assets covering the total liabilities and overall good even when taking the client-related funds out. They have a lot of goodwill though as a result of the acquisitions, so you don't really get that many real assets, although that's pretty normal for a tech business. Still, they have enough cash to pay the debt, and making 4 to 5 billion in cash flows on such a balance sheet is pretty impressive. They spend 3, 4, 5 billion on buybacks, which is already pretty unsustainable. But they have 22.5 billion in treasury stock, which they can use for decades of compensation, so buying them now can be a very smart move. I haven't seen people talk about this, they don't have to, but if they buy so much now, they can save a lot of money in the future, so even if they pay more than the cash flow, that can be kind of an investment. So if they get to, let's say, 200 per share, that's close to a 4x on their investment, and they can just focus on dividends if the stock is too expensive. You know, they won't have the burden of buybacks at any price. They can cancel, let's say, half and pay the rest as compensation or add them to the treasury. So this level of buybacks plus interest and debt repayments isn't sustainable, but they have the cash and equivalents to keep it up for a few years. So if they keep seeing a discount in the stock price, they can continue to theoretically pay around 8% in buybacks. We can see a clear trend in the market where this kind of digital transaction should be more and more popular in the future, so there should be an underlying support to their future growth even if there is higher competition. But keep in mind that they are very exposed to the economy, meaning that a recession can easily make this crash and make the price more attractive. And the time after a recession or a rate cuts which would stimulate the economy can lead to a lot of transactions, which would be great for the industry. What's impressive about them and the rest of the market is that during a time of high interest rates which are made to slow down the economy, they kept growing. In the future, when the rates are cut, I think that if the new management can seize the opportunity, there is potential to do very well. But it's an if, and this team can be much worse than the previous one, and this is a risk to always keep in mind with turnaround plays. As for a valuation, let's go through 3 scenarios to get an idea about the upside and downside. In a negative one, let's say they fall to 3 billion in cash flow due to competition and all the negative arguments. For a ratio of 10, which would be pretty much the lowest in history, that's a 30 billion market cap, meaning a price of 28.7, so pretty much a 50% loss. That can also be possible during a recession, although that would be temporary. In a neutral scenario, let's say they keep making 4 billion per year. If they get to the relatively low ratio of 15, that's a 60 billion market cap, so pretty much the current level. I think this is roughly what the market expects because with all the changes in management and the negative arguments, it's very tough to model anything. But if things are working and they get to, let's say, 6 billion per year, the ratio would probably get back to the normal of around 25. That's a 150 billion market cap, meaning a price of 143.5, so a 150% profit. Sure, they can make 7 billion at a ratio of 35 and that would be much better, but from the current price I don't really see that much potential. If they get to 40 or below 50, this would be much more attractive. Can they get back to the pandemic and lockdown hype level from a couple of years ago? Maybe, but then it would probably be very expensive. I think something like 100 to 150 would be a more realistic expectation. You know, they aren't a company worth like 250 billion like they were back then, and they never actually were. That was pure market hysteria. Sure, if they develop, they can get there, but that's in the very long term. So overall there is potential and this is a relatively okay price, maybe even on the cheap side. The company itself is good and it has potential to develop, and despite all the negative arguments, I think the market's reaction may be exaggerated. I'm not going to buy it right now simply because I think there are better options in today's market, but I'd consider opening a position relatively soon. I think this is a good price to average down from and the risk reward looks pretty good. I'd really like to buy this during a recession or something because the price would probably be much better and the potential after it would be huge. And don't get me wrong, there is potential, but there is also risk. They are in a transition stage and like any other turnaround play, this is risky. Don't buy this thinking it's a guaranteed profit. There is no guarantee that the new management isn't absolutely terrible and won't ruin the company, so we have to balance this with the potential that they offer. And again, I think people have to maybe lower their expectations. It's very unlikely to see this 5 or 10x in the medium and even the long term because even if it's a good company, unless there is some market hysteria again, they aren't worth nearly that much. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.